Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Canadian active ETFs are having a moment, reshaping how investors think about diversification, growth, and what it means to stay ahead. And as we enter the last quarter of this year, Canadian equities continue to capture strong inflows. What are the latest market trends shaping the next phase of ETF innovation? And why does our next guest say he prefers a factor-based approach to find the winners in the market? Joining us here today for a discussion on his ETF playbook, including a timely update on Fidelity All-in-Ones, is ETF strategist Vince Kraljevic. Great to see you, Vince. Welcome. How are you?
I'm doing fantastic. Thanks again for having me.
Delighted to have you here, and we'll invite everyone to send their questions in for Vince over the next half hour or so. So let's catch up on the flow story, because this is always fascinating. You go month by month. You get to where we're at the end of October. So what numbers have you got?
Very impressive numbers. So 2025.
And you've got September.
Yeah, so we have September 30. Okay. So we get it quicker in ETFs than we do in mutual funds. Usually IFIC or whatever they're called take a bit longer to aggregate that information. So with ETFs, we usually get the information a lot quicker.
That's great.
And 2025, just a gangbuster year, record-breaking year. Like every quarter, every month, I'm saying, oh, we broke some form of record. So 2024, net creations or total inflows were $76 billion at the end of...
This is the industry.
That was the industry, yeah. So the industry in 2024, record year, $76 billion. And then end of September, we broke that record. So we're $85 billion worth of flows by the end of Q3. So we have another quarter of inflows or creations, fingers crossed that we don't go into net redemptions. Probably not, but weirder things have happened. But yeah, so record-breaking year, and it started off like best start to the year. I think March was the best month of the year. September was second best of all time. Best first half of the year. So just like tremendous amount of growth in the industry. And one thing hopefully we talk about is the all-in-ones. Is that category has been growing exponentially for a number of reasons I've talked about before. But it's over $55 billion, like approaching. So in the ETF category, that category is almost 1/10 of the entire industry. So it went from nothing to now just is following the exact same trend line of balanced mutual funds, right? First it was equity, then fixed income, and now these all-in-ones or ETFs of ETFs are slowly picking up pace.
This is one big growth story. Okay, so Absolutely. That is the industry itself in Canada. The Fidelity story within that.
Yeah.
There's a top 10 that obviously gets looked at.
Yeah.
Where are you in that?
So based off our current growth rate, we will probably be the fourth largest manufacturer by the end of next year. So in a year's time, we might be the fourth largest ETF manufacturer in Canada. And you know, some of these numbers I've given you before, but we'll update them. So we had a capture rate of about 11%. Year to date, we're capturing about 15 cents on every dollar that goes into the ETF. Wow. Our all equity and our conservative all-in-ones, they hit a 3-year track record in January. So we saw a big uptick.
This is FEQT?
Yeah, FEQT and FCNS.
Okay.
Right, so they were launched a year after our balanced and growth mandate. So they hit a 3-year track record in January, 5-star Morningstar rated, excellent performance. And then we just saw this hockey stick of growth. I used to say our all-in-ones capture about 25. Now they're capturing about 1/3 of all flows into that category. Hopefully the next time I'm on, I can say it captures 50%, but you know, fingers crossed, but we'll see what happens. And 2 of those are now in the top 10 of best-selling ETFs in Canada.
Okay, well, congrats. This is amazing. So let's go just through that 3-year, what it means also, because a lot of things through Fidelity have been launched somewhat recently, but they have to get to that 3-year mark to sort of get taken in and looked at over a period of time.
Yeah, for a number of reasons, yeah. Absolutely. So I think we were chatting last time about Morningstar. Like for Morningstar, they usually want a track record, and that track record is about 3 years. So once you get a 3-year track record, they look at your returns, they look at your volatility. They might look at a few things. I'm not an expert on how, I don't work for Morningstar, so I don't know how they rate.
Right.
But they do their analysis, and you know, all of our all-in-ones, once they hit that 3-year tracker, got a 5-star Morningstar rating, right? And once you see that, it's very impressive for that purposes. The other thing is a lot of compliance departments for dealers, they want a 3-year track record as well. So when you hit this 3-year track record, it kind of opens everyone's eyes or puts a spotlight on extremely good funds, right? Like if you get a 1-star Morningstar, that's usually, you don't want to talk about that, but if you get a 5-star Morningstar, like
we're not going to
usually,
profile this.
that's
not the case here. So that's absolutely not the case. So what do you think about those particular funds that has been, I mean, you talk to people and clients all the time, what they want, what they're looking for. The two funds that are in the top 10. I mean, equity has been the story. Yep. There's no question. So I guess that answers that question.
Well,
is that why?
So there's a few things. So the reasons that I see our all-in-one suite growing is that it does offer alpha relative to our competitors, right?
Okay.
So we've used a factor-based approach, and since inception, they've outperformed 3 to 4%. So we're a bit more expensive, but we generate that outperformance. And a lot of advisors, and this is why I think the 3-year number really matters. The client, compliance approves it, kind of goes on a rec list, and you get the dealers kind of looking at this, going like, here are these two products, right? What's this one doing? And we get phone calls, we explain what the process is, and you get that uptick. So the balance mandate is one of those, it's an excellent 60-40 portfolio, it fits so many, but the equity sleeve is younger clients that don't have a lot of money. So for smaller accounts, for like the first time home buyers account, or it's TFSAs or things along those lines.
They're going equity.
They're going all equity. They're 24 years old. They don't need any fixed income. I always make a joke, like 40% of your portfolio is in fixed income, generating 3 to 4%. So for 10 years, it's only making 3 or 4. And if the stock market is expected to make 7 to 9, like you're literally losing half of the table. So if you're 23, 24, single ticket solution, a lot of advisors, they're taking on younger clients, and they don't have a lot of assets, so it's this excellent single ticket solution for those smaller accounts.
So is that really the story? Like people who are at that age and going to an advisor or whatever the dealer situation is, and that is who is causing some of this uptick? Like there's major, it's as a sleeve, this is really interesting to investors.
Yeah, so we get a lot of data from some of our service providers as well as internally. And there was a report done by one of the major banks that says 90% of these solutions are bought by do-it-yourselfers.
Really?
Right?
Okay.
And they just do it, they go just based off of fees, and they go, okay, this is great, it's a single ticket solution. I read somewhere, buy an ETF, that's cheap, and here you go. Our internal data, last time I spoke with the head of product, was we're seeing the complete inverse. We're seeing like 80 to 90% are being bought by advisors because they're like, well, here are two products, but yes, it's 20 basis points more expensive, but you're generating X amount more. So they're looking at returns net of fees, right? So we're seeing like the inverse of what the industry is. Everyone's doing like do-it-yourselfers, but we're seeing a lot more from advisors doing their due diligence, their know your product requirements, and we get a lot of questions as to like how we do it. Is it repeatable? We go through the process, and we definitely get more uptick from that. We're actually trying to break into the do-it-yourselfers.
Yeah. Well, because it sounds like there's a lot of momentum, pardon the pun there. But let's talk a little bit about the factors that make these very active strategies. This is the way that you look at things. Bobby Barnes sometimes will join Fidelity Connects and talk about where he thinks the factors are going and what they're doing and the strategy there. But just talk about those in building the ETFs.
Yeah, so again, if I repeat myself, I apologize for those that haven't heard this story before. So we at Fidelity, when we first launched ETFs, we didn't want to launch another passive product. Like we were not that last. We always see what everyone else is doing, and then we bide our time. We speak with advisors as to what they want, and they wanted to customize their portfolios, right? Like here's the S&P, here's the TSX, but my client wants lower volatility. My client wants this. So. And we at Fidelity have a stable of excellent portfolio managers. Like I can list 100 of them going back to the 1960s that have outperformed the S&P 500. Like I was in Florida last week for our Vision event, and people were taking photos with some of our portfolio managers. They're like celebrities. So we have this excellent stable of portfolio managers, and we have an excellent amount of data that we can collect from them. And Bobby Barnes is the head of the quant team that I specifically work with. He helped design our ETF platform. Every time I speak with him, I learn a very new, interesting fact. So the first one I heard was he was a rocket scientist, he worked on the Mars rover program. Then I heard he was one of the most influential people in designing the Motorola Razr. That was, I think, my second or third cell phone. Then I heard he worked on a top secret military contract with the US military. It turned out to be the beginnings of 5G technology, which he has 2 patents for. And then I heard something on stage last week. I had a call with Bobby yesterday, but I was in the back of an Uber and it felt weird talking, so I just like listened with my earbuds. But I think he was an embedded quant for one of the portfolio managers, so I'm going to have to clarify that. Okay. But That's the difference between us and a lot of our competitors that use an academic approach. So we have Bobby that worked with PMs and he saw how they were doing it. So when we designed our factors, we didn't approach it from, oh, here a textbook says do this, because in the real world that doesn't apply, because there's trading frictions, there's rotation, there's psychological things that happen. So Bobby was influential in designing the first wave of our ETFs. So I think it was first dividend, then we launched the entire suite of factors. The 4 that are in the all-in-one are quality, value, low volatility, and momentum, right?
And all of them have exposure at all times.
All times. So with our all-in-one suite and even our regional ETFs, so we have the all equity for Canada, United States, and international. So again, clients came to us saying, we love the all-in-ones, but can you like break off the region? So we did that for them. And to your point, we just equally weight them. Yeah. We know that factors work over time, not all the time. Yeah. Right. So we don't know which one's going to work. And with the U.S. administration changing, like making a lot of changes, momentum was working very well. Then low volatility back to
no. I was just going to say, so on that point, like when we entered the year of, which seems like a really long time ago, the thought was that the factor most at risk, just because it did so well, was momentum. And then it continued to do quite well. And then there were hiccups. And then it came back. What's the risk of momentum at this point? What would you say?
So the risk with momentum is, so we approach it from a different perspective, but momentum works until it doesn't, is kind of the issue with momentum. And right now, it's high quality companies trading reasonable cash flows. And if you think about the market in general, there's a high concentration risk, right? Like if you look at the top 10, and not that our portfolios have the same concentration as the top 10, but if you think about everyone's talking about artificial intelligence, the top 10 companies make up 40% of the S&P 500. So if that story breaks down, it could kind of ruin the momentum trade in general.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
I mean, there's lots of discussion about that breaking down. Nobody really knows if it will, but there's sort of concerns about the concentration risk and how high up in the skies that discussion has gone. And there's much more discussion about looking at other parts of the stock market for your investments. Take us there on how the ETFs handle that, essentially.
In terms of our ETFs or like competitor ETFs that are like...
Why don't we go across the industry first of all, just sort of the concerns, because you can be very exposed to that, but then you also maybe want to make sure there's some diversification.
Yeah, absolutely. So with regards to the concentration in the United States, the two biggest things that we see people doing. So, top 10 companies make up 40%, trading at extremely high multiples, so they're afraid of the valuation concentration risk. So the simplest solution is just equally weighted. Right?
Yeah.
So a lot of people
just go right across the board.
Yeah. So, the top 5 companies make up 25%. Let's make them 1%. The bottom 50 make up less than 1%. I think it's 75 basis points, like less than 1%. And let's make that 10%. But those 50 companies at the bottom, one, they're smaller. They're small cap effectively.
Risky, yeah.
They're not really high quality. Some of these might be kicked out of the S&P 500 on the next rebalancing. So the unintended consequence
of a passive approach to an equal
weighted approach is you're avoiding one problem, but you might be creating 2 or 3 other ones. So the problems that you create by going equal is you're going to small cap, which depends on your opinion on if you think it's a risk on. Like if you think it's risk on, then that's fine. They're typically lower quality, right? Because usually the best rise to the top, the weakest go down to the bottom. And then you're going anti-momentum. Usually if you're doing well, you're going up. And if you're doing poorly, you're going down. So you're kind of making these 3 bets that are most likely unintentional. Like you're trying to avoid one problem and you're creating another one. The next thing that we're seeing is a lot of people are going from large cap, mega cap, and they're like going, okay, we're going to go small cap. And they're buying the proxy of the Russell 2000. And again, if you think that's going to work, that's completely fine. But there's a few unintended consequences of that. You're going from massive concentration to smaller cap. The S&P 500, like 2% of the companies aren't profitable. I think 40% of the Russell 2000 are not profitable.
So you'd be catching all those.
So you're catching all of those
Yeah.
in a passive approach, right? So you're going from extremely profitable, high quality, back down to small cap and low quality. The other thing within that is the Russell 2000 has been trading in this range for the last, call it 4 years.
Right.
So it comes up late last year, we think it's going to break through, it goes back down. So it's been in this range. It's just recently broke through this range, mainly based off of small cap tech, right?
Yeah,
These
right.
quantum names and things, these derivatives are artificial intelligence. Again,
Often non-profitable.
often not profitable. So now you're trying to get away from big tech and then going to quality tech to low quality tech.
Right.
So I wouldn't say that that's a good trade. Like I wouldn't take that trade. If you are thinking about small cap, we definitely have Connor and Chris. They can speak to their strategy a lot more, but they go through the entire global universe, about 60 names, and they focus on quality small cap.
60, yes. Yeah.
Depending on what they've seen, but it's like a highly concentrated portfolio. In the investable universe, I think there's 6,000 names, so they have an active share of 99%. Like they're eliminating a lot of non-profitable. They're looking for high quality, and based off their background, if I remember correctly, they really didn't cover tech and. Tech,
more industrials
and utilities and things along those lines. So they kind of avoid that. I think they have a 10% underweight relative to their benchmark.
So this is their U.S. small cap offering that they take a look that is an ETF.
Yep. Yeah. So the Fidelity Small Cap Opportunities, Global Opportunity Cap, and it's a better way. So if you do want to make a small cap trade and you're looking at that universe, why not buy high quality ones?
Okay.
Right.
Absolutely. In the U.S., you were mentioning this before that their approvals are changing. Actually, regulations are changing. Lots of financial regulations are changing. We're listening to all kinds of things that are switching up. One of them is what is allowed in terms of ETFs to be issued and traded ultimately. There's a lot in the U.S. Now, we're talking obviously about the Canadian market, but I wonder, there's always consequences when there's a big shift somewhere. Tell us a little bit about that in the U.S.
Yeah. So with regards to the United States, to buy an ETF, you can literally buy an ETF on any exchange. So it's like buying a stock. So if there's an ETF on the United States, you can definitely buy it, just like an American can buy a Canadian ETF.
Right.
Now, so gangbuster year, like again, record breaking. I think I read a stat that here in Canada, every trading day, we launch 1.5 ETFs.
Okay.
Right? 65% of those were active ETFs. In the United States, they're launching almost 4 ETFs a day, a trading day. And 85% of those are active. And that's before this regulatory change is happening. So to give you a bit of a background, there was this one company that had a patent for an ETF series. Mm-hmm. We in Canada have always been allowed to launch, not always, but recently, about 5 years ago, we were allowed to launch ETF series. So the rules in Canada and the United States are different. I'm not going to get into the granularity of it. But in the United States, there's one company that was given notice of approval by the SEC, which indicates that they might be able to launch an ETF series of their successful mutual funds.
Okay.
So as I said, if you can show a track record, like here's this mutual fund that has this 20-year track record,
right,
the people are going to be gravitating towards it. And it's not only this one, there's I think 70 in the queue. So there could be 70 manufacturers that have active mutual funds that they might launch an ETF series on.
Okay.
And it's come up in conversation that people have asked, like, what do you think about this? And there's unintended consequences. There's a currency problem as well as taxation.
Like if Canadians were to buy those?
Yeah, if a Canadian was to buy that, there's a few slippages. Like if you're buying in small increments, there's the currency spread. There's also a double taxation potentially. Donald Trump the U.S. administration was making comment that they might increase the withholding, and then they backed off on that. So there's these little tax issues, but the biggest consequence or the biggest unintended consequence when I was an advisor was that there might be an estate issue. So if you own a U.S. asset, you might have to file forms with the IRS to resolve your estate.
Beyond just like the ones that we signed,
beyond what you signed here in Canada,
yeah.
If you're over a certain threshold, you might have to sign some forms with the IRS, and it might hold up probate, might cause all these problems and unintended. Like for 3 basis points, I don't think it's worth dealing with the IRS to resolve probate over anyone's estate. So I would steer away from it, and you just need to do enhanced due diligence. You'd have to stay on top of U.S. tax law, U.S. estate law, and if something goes wrong, it's just someplace that I tell clients probably That's not to fish in that pond.
Okay, so the idea is that these offerings may be there in the U.S. easily buyable, but with those concerns, you may consider just staying Canadian in that kind
I would recommend staying Canadian, or
Okay.
you have to do a lot of due diligence with regards to what you're buying to make sure that you don't harm your clients.
That's really, really interesting. Do you think, in terms of themes, small caps certainly is a discussion that we're having there, exposure to the U.S., broadly speaking, there was a time where international has been flying actually through much of the year. It's an interesting trade. You have an offering for it. I'm always curious whether you think that has legs. There's always this, well, maybe we'll just go back to invest in the US because maybe we don't need to look outside that. What are some of the comments and thoughts you're getting there?
Yeah, so when I was...
And flows.
So when I was on the show, it was first buy America because of US successionism, then it's buy America because of the tariffs and people didn't want to touch the United States. It was buy American again. And year to date, international has still outsold the United States, and for a number of reasons, right? So firstly, just the gross underexposure. Like in speaking with advisors,
it's a value story.
It is a value story, but you never had to buy it before. Like in the last 15 years, it's been a widowmaker trade. No one's had any exposure to it. I've seen some advisors that have been exclusively North American, like no international exposure. So depending on what benchmark you're using, you have an underweight of 25 to 50%, right? So it's one of those things that this opened up a lot of eyes. So if you had no exposure, you're like, okay, maybe I should have 10%, right? Or our all-in-ones have a 25% weight. And a lot of people ask me the question, even in your all-in-ones, you're underweight the United States. And I ask how? And we have about a 50% allocation on the equity side, and we have a 25% sleeve to international. If you look at the MSCI World Index, in the 1980s, the United States was only 50, then 30, then it went up to 50, and now it's 70%. So if there is this rotation, if the AI story doesn't work out and old tech, so financials or industrials or utilities, there could be that rotation. Like the United States went from 30 to 70. Now, is it going to go from 70 to 90, or is it going to
go the other way?
Go the other way. You're hearing all these stories in Japan, the modernization in Japan, the modernization in Europe. Europe is going to start going from austerity to spending. So there's all these tailwinds.
So the international catches all of that.
The international catches all of that. Yeah. And again, to your story, it's a value. If you have two companies that are doing identical, in the United States, it's trading at 20 PE, and in international, it's trading at 10. And it's same operating margins, profitability, earnings, same client. Why would you pay twice the amount of money for a company
something
that's
similar?
Exactly.
So it's interesting. As you mentioned, the all-in-ones have exposure to all of the momentum growth, low vol, and what are we missing? Momentum growth,
quality, value, momentum, low vol.
Quality, yeah. So, but if we had to ask you what you think is your, factor of choice right now, is it shifting? Is it away from momentum? What would it be?
That's an interesting question.
That's what people say when they don't want to answer the question. Yes.
When they don't want to answer it, yes. So most people ask in the United States, and so I'll answer the question on the factor, which I think has tailwinds in the United States. And quality momentum had been doing well, but if you start looking at what's kind of happening with a few data points, so again, there's that concentration. So you have the AI story, concentration, big PE, right? And what happens if that fails, or if it stutters, or something along those lines, right? The opposite to that is value, right? Typically, you're trading at a very low multiple. And the reason that value does well is because it's already beaten up. Nobody wants to touch it. Everyone's like, here's a shiny thing, artificial intelligence. Nobody cares about a trucking company or anything along those lines.
Except for you need the shiny thing to come via truck.
Yeah, exactly, right? So you have these industries that have been kind of forgotten. They're trading at below what their intrinsic value might be. And then you have this rate cutting cycle, right? Usually, if you're cutting rates, then the companies that had a bad story, like they couldn't pay their loans or something along those lines, then their EBITDA, their profit margins start improving, things along those lines. So it's kind of the early cycle. So usually momentum quality work in mid, late, and then low vol and recession. If you get this soft landing, or you just go we're cutting rates, or
we're just not having a recession.
Or we're not having a recession, it just skips over. It has some of the inklings of early cycle, right? And I'm not saying that and it's like this hard thing, but sometimes if you're contrarian, you're like, okay, if everyone's looking at artificial intelligence, like here's something, small cap is usually risk on trade. It's kind of been rallying, not profitable, right? But then value also works at that time as well. So there could be this story that, and you are kind of seeing a kind of uptick in value that's happening if you just look at its relative strength against competitors.
So do you think, I mean, it's totally philosophical, but just the idea that for so long, U.S. exceptionalism had been the only game in town. It was the TINA discussion. And then international sort of got some wings, and it is basically a value play. I'm just wondering if it sort of opened up the possibilities. You know, you just wonder how things link, and maybe they don't link for you. But
no, and you're looking at relative. Everything's relative, right? If
things are expensive.
Yeah, these are very expensive. Here's something that's not expensive. What do you think the expected returns of these things are? So it is like there's always these most hated rallies of all time. This is like one of those things. If you look at the rally in the S&P since the beginning of the year, it was dominated by quality. Usually rallies like coming off of a trough is like, oh, these beaten up companies, so we'll buy those. And then, but psychologically speaking, I would say that everyone's afraid to make a call. So they just went to what they know, the high quality companies, nothing's going to go wrong with that. But now you're looking at, we'll see earnings, right? So one of a streaming service provided their earnings yesterday. If they start missing earnings, people are going to start looking around at, why am I paying so much for this if we have something over here? And then there's what's the use case, right? So artificial intelligence, we have these massive companies, I don't know how many artificial intelligences there are, and those technologies usually consolidate, but who's gonna use artificial intelligence, right?
All the other companies.
Possibly, right? Like if you're a travel agent company and you ChatGPT can create these trips for you, like maybe you don't need all that stuff. Or if it's kind of like an Internet of Things story as well, right? What if these trucking companies use artificial intelligence to improve logistics and planning and things along those lines? So if they
without a driver,
without a driver,
well, that seems to be the other piece of the trucking story, but yes.
But you're waiting for the use case, right? So everyone at the beginning of the .com was looking at that technology only to realize that the killer app or whatever came down 5 or 6 years, and you have to turn over rocks. It's probably not where you think it's happening. New tech, new economy, old economy. And I think there's a bit of a story for old economy or, things people haven't looked at for a while.
So just to sort of sum up, incredible flows. It's been quite a year thus far for the industry, for Fidelity in particular. And maybe good to take a look at a slightly shifting narrative here. It sounds like you're talking about a little bit of slightly shifting narrative. Yeah. Pendulum swinging of sorts.
Pendulum swinging. And again, ETFs have always been known to be passive. Right. So every time people are asking me questions, it's always about like the passive index. And there are unintended consequences of index construction. Right. With our factor approach, we're like, well, you're the most profitable. So why don't we give you money? You're the one that's trading at the fairest price. Why don't we give you money? You're showing the best momentum. Why don't we give you? So we build the index using fundamentals, like what we learned from our active managers. Right. So it's momentum, or an index works until it doesn't. Nortel went from 0 to 1/3 of the TSX and went back down to 0. And if you're in a passive product like that, you kind of ride that wave. And same with the Magnificent Seven. They went from 0 to 1/3. And will they go down to 0? Probably not. But is there something else that you're not paying attention to that might come up? Possibly. So yeah.
That's fascinating. Really great to have you share your thoughts and sort of the industry view as well. Vince Kraljevic, thank you for joining us.
Thanks so much for having me.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.